All right, guys, good morning. So let's try and sift through the dust as it settles on that Fed meeting last night. I think actually what you're seeing, it's a tricky one here. What you're seeing today, this morning, is dollar strength that maybe you should have seen last night. But let's just, you've had quite a strange set of market reactions here, I have to say. When ultimately now at least you've got dollar strength, but you've got equity strength at the same time. I don't think anybody would have predicted that, to be quite honest. The dollar strengthening and equity strengthening. That, if you'd have asked someone before the Fed event whether that would have been possible, I would have argued that no, it wouldn't have been possible, and yet that's exactly what's happened. Also, when you're looking at bond yields, I guess you've got to look at the different durations, and certainly on the short end, of course, rates got hiked, and so the 2-year government bond yield in the US broke up above 1% for the first time since 2010. But looking at the 10-year, the yield's lower than it was before the meeting. So it's very odd that bonds have gone up, the dollar's gone up, and equities have gone up. That shouldn't have been possible, and yet that's kind of what's happened. So let's just try and piece through this. And maybe, look, we'll use the dollar against the euro during the meeting. Let me just bring this chart up, because it's a real mess. I mean, from a trading point of view, last night was a bit of a nightmare. And this chart sums that up perfectly. First you get the kind of spike lower, and it was a decent spike lower, I guess. In that we got about a 70-odd pip move to the downside, as it was announced that that rates are going up by the expected 0.25%. But even though the majority thought that would happen, there's a minority in the market who thought it would not, and so they were wrong, and so we got this adjustment. And then I would say, the mess kind of began as we fully retraced that move. So literally 20 minutes or even 15 minutes after the announcement of the statement, the euro dollar made it all the way back to where we started, or even 10 minutes after, we got back to where we started. Then we chopped around a bit. Then we had a push to make new highs, topping out around about 1 in the end. And then check out what happened by the time we got to 8:30. We're back down at the lows, and that's kind of where we tracked into the close. And in the end, the euro dollar closed, for a massive Fed event, basically unchanged, because we closed about 30-odd, 40-odd pips lower, and that was it. Of course, this morning we're getting we opened lower, and we broke down below the 109 handle, and we trade below 109 now as I speak. So you're getting dollar strength. Now, let me just talk through briefly the comments that Yellen made, and then we'll have a look at the all-important Fed dot plot and how it changed. But just to review very quickly, what the statement said and what Yellen said. They said that the outlook for economic activity and the labor market is now balanced, rather than it being nearly balanced, which is what they used last time. Obviously, a lot of the attention came on the dot plot matrix that I'll show you a picture of in a second. But I guess probably the important line, which was entirely expected, was this one. The committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. Then emphasizing the dependence on incoming data. Also, as completely as expected, the Fed are expected to maintain the current size of their balance sheet until normalization of the level of the federal funds rate is well underway. So that means they're going to continue to any funds that come in from maturing assets gets reinvested, so maintaining the balance sheet. at some point they're going to stop reinvestment, and that will be the beginning of the reversal of QE. But I think we're a long way off that yet. I would imagine you're not going to see that start in 2016. Might be more of a 2017 story, that one. So, in terms of the forecasts on GDP, unemployment, inflation, mixed. And this is where it starts to get a bit messy and why we've got the market reaction you can see on my screenshot with the euro dollar. On the one hand, they upped their GDP forecast. So by 0.1%, 2016 growth is now expected to be 2.4%. But to counter that, they downgraded the 2016 inflation forecast by 0.1%. So a bit of a mixed bag there. But look, let's just talk about this. And actually, the FT have done quite a good thing here. This is the dot plot matrix in one chart, but look at it. The chart's updating every few seconds to show 2015's changes. So starting in March of 2015, remember they update this dot plot every 12 weeks, so once a quarter. So March, there you go, June, September, and of course finally the updates from yesterday. So this is quite an interesting graphic because it shows you how the dot plot has changed. And well, we were talking about this at length yesterday. I think markets got it wrong last night, in that ultimately I thought the most important thing was 2016 forward guidance. Now, 2016 forward guidance stayed unchanged. It was the only thing on this dot plot that didn't move. Actually, that's not true. The longer run didn't move either. 2016 didn't move. Now, bearing in mind that apparently markets are pricing in 2 rate hikes next year, and here's the Fed telling us, basically at the start of 2016, that we're going to have 4 rate hikes. There's a difference there, and that was not reflected in market behavior last night. The reason being that 2017, as you can see, got lowered by, let's say, 1 hike. We're now going to have, at the end of 2017, we're going to be 1 hike less than was thought, but that reduction of 1 hike is going to come in 2017, not in 2016. So we're going to have faster rate hikes in 2016 than the market is pricing in. And even though they downgraded 2017, it's still faster than what markets are pricing in. So I think that the dot plot matrix changes were hawkish, more hawkish than the market gave credit to last night. And I think you're getting, let me take that graphic off. And let's just go to now. Let me get rid of this short-term chart of the euro dollar looking at last night and look at what's going on right here. So you're getting dollar strength, and it's not just against the euro. Here's cable, which is broken below the 150 handle. If you look at the daily chart, that we're not far off and most likely going to get a test of the 149 handle, the December low. Be aware of that price point for today's session. That's the 7-month low, around the 149 handle. So you're getting dollar strength now across the board, which really should have happened last night, but didn't. Now, what's going on? Normally, you'd have said, well, dollar strength, hawkish reaction, surely that's bad news for equities, except it's not. It's the exact opposite. You've had actually a really strong rally last night in US, and check out the DAX here. That's 2.75% up on the day. Just straight out of the gate on the open. Big moves to the upside here in global sort of risk assets. So it's almost like equities are behaving. The behavior of equities is this. It's like relief, kind of finally, the Fed have managed to get over this annoying hurdle of beginning the rate hiking cycle, and there wasn't any chaos in markets last night, and it's almost like a bit of a relief. Let's kind of get on with it. That's kind of the way equities are behaving. And then the dollar, after some real confusion last night, is now behaving, I think, as it should do, which is a mild hawkish response to the fact that ultimately we're still not priced. We're not priced properly for 4 hikes in 2016. Why isn't it a bigger move? Well, maybe people don't really pay or give too much credit to the Fed's forward guidance, and that's because they keep changing it. So the Fed may well be telling us that they expect 4 hikes next year, but actually they don't know how many hikes there are going to be. We don't know how many hikes there are going to be. So we can be priced differently to what the Fed tells us. One of us is going to be wrong, either the market or the Fed. There's only one thing that's going to determine which one's going to be wrong, and that's going to be economic data as it comes in 2016. So fortunately, we are kind of back to data dependency. So I was asked a question this morning. Let me go to a longer term chart here and just take a step back and have a look what's happened in 2015. And basically nothing. That's the answer. What's happened for the euro dollar in 2015, basically nothing. Because we're basically trading the prices we were trading back in January. We've been in a range, 1,000 pip range. We've been ranging between 105 and 115, okay? And we're in the middle of that range. And where do we go from here? And I don't think we really go very far. I don't think that right now we've got information that would suggest that this range is going to break to the upside or the downside next year. I think right now we're neutral, and it's going to just depend. This range might break to the downside if, and only if, the Fed's right and we get 4 rate hikes next year. Now, how are we going to make the decision that the Fed are right? Well, we're going to need to see improving economic data. We're going to need to see wage growth, continue to build momentum. We're going to need to see inflation, core inflation, move up above 2%. This is where we're then going to price in 4 hikes, because it's not priced in at the moment. We're going to price in 4 hikes next year only when data tells us there's going to be 4 hikes, not when the Fed tells us. So we could break to the downside if you get strong US data. We could break to the downside if European data's worse, and so Draghi starts telling us they're going to do more. Well, fine, then we'll break to downside, euro weakness, so we could go lower. But we don't know yet. Equally, we could go the opposite way. What happens if data in the US doesn't improve? And so the Fed are wrong. We're not going to get 4 hikes, we're going to get 2. Well, that'll lead to dollar weakness, and we can maybe break higher. What happens if European data really picks up and improves in 2016? Well, then perhaps the ECB are done. Maybe they don't need any more stimulus, in which case, right, the euro is going to strengthen. So we could break to the upside of this range. The point is, at the moment, we don't know. There's not enough info to determine which way it's going to go. So I would expect some mild dollar strength into year end, but really against the euro, where does this thing move in 2016? We cannot say until we get more information. The 2 central banks have made their moves, and the Fed did what we thought, and the ECB didn't, and that's it. What they do next will be dependent on the data. So I think, 2016 is going to be an interesting data-dependent year. Can equities continue this rally? I think, well, look at oil. We didn't talk about oil really at all yesterday, given the fact attention was on the Fed, but actually we had a big sell-off. It kind of went under the radar, and it's selling off again this morning. And of course, the dollar strength that we're seeing is certainly helping with this, and the fact that the supply situation remains the way it does. We didn't really pay too much attention to oil and the Department of Energy numbers yesterday afternoon. Let me just remind myself of those. Give me a sec here. Sorry. 4.8. Yeah, so here we go. I've got the numbers now. So we had a 4.8 million build, so we expected a drawdown. And also the output levels increased. It's just remarkable what's happening with production and how resilient it is in the US. So output went up by 0.13%, and we got a much bigger build than expected on the headline. We got a build on gasoline more than expected. We got a distillate build more than expected. The Cushing number was marginally larger build than expected. So it was an outright bearish set of numbers. And so, and now some dollar strength. And so here we are with crude back testing the $35 handle. Here's the low of the week set on Monday, 34.53. That's the kind of 7-year low, as you guys know. So keep your eye on oil. Can equities continue to stay positive following the Fed? I think if oil continues to move lower and if the dollar continues to strengthen, then no, equities cannot rally. They cannot add to gains. And most likely they'll reverse some of these gains. I think it's really strange that you've got now some dollar strength, which makes sense, but still equity strength. I get it that now, okay, finally the Fed have made their move, and markets haven't really freaked out, and that's a relief. I kind of get that, but ultimately that alone isn't really, I think, a reason to have a strong rally into Christmas when you're getting oil again threatening the $35 handle and the dollar's strengthening. So we'll see. It's a very impressive response from the equity sector, I have to say. But yeah, keep an eye on oil today. Definitely important, of course. This morning we've had a big breakout on bunds here on the upside. T-notes joining in, but not to the same extent. T-notes testing the sort of spike high off yesterday's off yesterday's Fed event. But it's the bunds certainly that's outperforming, with a kind of key technical break to the upside this morning, which is just kind of calming down a little bit now. If I go to a 5-minute chart, it's a pretty solid move between 8 a.m. and sort of 8:20. It's kind of consolidating that now, as you can see.
A lot of us have been watching.
Keep your eye on oil here, still on the low, testing $35. Let's have a look at the data. We're past the Fed. As I said, we're kind of data dependent now for the Fed and the ECB, and that will really shape whether or not we are going to get this dramatic monetary policy divergence or not in Q1 and let's say Q2. Are the ECB going to do more? Are the Fed going to hike 4 times? That'll be the dramatic monetary policy divergence. But you could get the opposite. You could get the ECB not doing more, and you could get the Fed only hiking twice, in which case that divergence will be a lot smaller. Let's have a look at the calendar for today, because there's decent data. I know it feels a bit like, well, the main event of the year is done, and, that's it, the year's over. But actually, we do have some key data starting at 9 a.m. in 5 minutes. So I'm going to wrap up the briefing here quickly because we've got German IFO, business climate. This is an important figure. We're expecting unchanged at 109. We've got retail sales out of the UK at 9:30, with the ex-autos and fuel number expected to be plus 0.5% to make up for the negative figure we had for October. So these are 2 important data releases. In the afternoon, again, some interesting stuff with the Philly Fed number. We're expecting a figure of 1, which is a very, very small, basically in line with last month's number of 1.9. Jobless claims as usual for a Thursday. And in terms of speakers, well, Putin's got a press conference, his annual press conference that starts, well, in 5 minutes actually. So maybe interesting to see what he's got to say about oil. One thing about the oil market, are they going to cut production, OPEC, next year? Only really if Russia are up for it. And so that might be an interesting press conference if he talks about oil and Russia's production. But we'll see. So I'm going to get off the mic here. German IFO due in 3 minutes. But for now, resilient equity response, especially in Europe, 2.74% up for the DAX, hanging on to gains for the S&P, although not above yesterday's high, incidentally. Oil's important as it tests $35, and we're getting, I would say, a delayed dollar strengthening reaction that really should have happened last night, as ultimately the 2016 dot on the plot didn't move, and we expected it to go down. All right, data, 2 minutes. Thanks.